Finally, time to write. Happy Friday, my friends. Oh, man. We have a doozy for you today. We're not going to start off looking at that chart. No. This is the one. No bueno. I'll tell you that for sure. It's not as bad as it seems. It's not as bad as it seems, but it's not good. It is not good. Not good at all, in fact. Silicon Valley Bank shut down. Huh? By regulators. What? How? How is this possible? Will there be a cascading effect? All the bears are going crazy online right now. This is just the beginning. Okay, that's possible. I don't think so, but I can tell you the problem, essentially the mistake that was made by this bank. Again, this all goes back to the Fed. The Fed, yeah, where do I begin? How badly they've screwed this up, how they've done exactly everything wrong, almost as if they're intentionally intent on destroying things. But I'm going to explain this to you. I think it's important for people to know what actually happened here. What is the truth behind this? Is it possible other banks are in the same position? First Republic also sold off huge today. It's down 60%. Is that really right? Or is First Republic a buy now? We'll take a look at that. We're going to go through mortgage rates. We're going to go through multiple things here. I'm going to talk about, we're going to touch on S&P. I think I have a pretty good feel for what's happening there. I'm short the NASDAQ, as I said on the news recently, and also, as I told you yesterday, am I short or am I real? Hey, if I'm right about this and the stock market's going to get shellacked, the fact that we're seeing mortgage bonds trade higher is really, really good sign and should mean that we're going to see lower mortgage rates as a result. And so that's what we've been seeing. Back down to 6% today on a high balance VA, which, we were all the way up to like 6.5% in just recent days. So we got some relief on the rate front, but as you can see, it's not a pretty candle. Not a pretty candle at all right there. But it does show you we still close higher. Buyers did kind of fade at the end of the day. Not too strange on a Friday, especially a Friday where we have the second biggest bank failure in the history of the nation. Okay. I mean, there's so much money that was lost in this that it's a little bit hard to fathom. I'm going to explain to you what happened. I'm going to tell you who's going to be okay and who isn't. I have a client who just got clear to close, by the way, right? That deserves some kind of love. Just got CTC, but they have a startup. And that startup's capital was in this bank. Now, they only had like 160 grand in there, so the FDIC insurance is going to cover them, but 97% of the depositors in here do not qualify for FDIC coverage. 97%. Whoa. That means that this bank wasn't just your average bank. This wasn't just B of A on the corner. This bank is where big money went. Big money was deposited here. Big money. Large money. My clients got lucky. They were just about to do another like $600,000 or $700,000 raise for their startup. If that money had been in there, they also would be SOL. Bunch of people SOL. Billions of dollars gone on this deal. So what happened? All right, let me explain this to you so that you know how impactful is this really for what's going on in the overall market. Let's go to a daily chart here. And I'm going to show you, we're just going to look at the 30-year bond. There isn't really an easy way to do this. Actually, let's go back to the weekly chart on this 30-year. Okay, now I have to invert this because this is showing yields on the 30-year instead of price. And so the yield and the price are inverted. But here's what happened. Silicon Valley Bank, been around for 50 years. In the COVID era, let's call it 2020 and 2021, there was tons of money printed. There was tons of capital, trillions of dollars injected into the system. Who got that capital? Where'd that capital go? Well, a lot of it went to Silicon Valley, went to investors, went to people who had lots of money, excess money. They were investing it with different startups and different tech companies and so forth. So money just flooded into banks. One of the banks that received an unbelievable amount of money was Silicon Valley Bank. 2020 and 2021, they had record deposits. Sounds great, doesn't it? It is great, kind of. But remember, when a bank receives a deposit, they're also accepting a liability. I mean, if you go and you deposit 100 grand in Navy Federal today, and they're going to give you 3% interest, then Navy Federal just they just acquired a liability. They now have a $100,000 loan that they have to pay back at 3%, right? So deposits are great because now you have money that you can lend out. But if you can't lend it out as fast as it's coming in, then you have liability issues. So how does that play? Well, what happened was they were essentially, and let's just use, this is 2020, okay, right here. So this is 2020. This is COVID. So this is the COVID top, if you will, on this, where this is 30-year bond prices. I've inverted the yield scale so you can see. And so between 2020, this is March 2020, all the way over here to 2021, this little box right here, this was the worst time maybe ever to be a buyer of bonds. Let's see, these banks, potentially other banks, for sure Silicon Valley Bank, they had too many deposits. They couldn't lend the money out quickly enough. So what they did was they acquired a liability. Well, they made an investment into a bond. Okay, that's what they did. They made an investment into a bond so that they had some place to put the money so they could get something back for your money to pay you with. Right? So that's what they had to do. However, look what happened since then. Now, the reason this is a problem is because banks are regulated and they're allowed to use leverage. In other words, they can use 15 to 1. So if they only have $1 million, they can lend out $15 million. They have liquidity leverage, if you will. And it's funny to me because people always say, oh, people are trading crypto on leverage and this and that. I'm like, do you know how banking works? It's just a huge cesspool of leverage. And it's times like this when they start, you think, okay, well, this bank received a bunch of money. They put that money into bonds. What's wrong with that? That should be fine. Problem is, now those bonds are worth a lot less than they were. Now, this would be fine and everything would be fine if people didn't withdraw their money. Because people are withdrawing their money, they now have to give people their money back. And in doing so, they have to then sell these bonds for way less than what they bought them for. So in other words, they have to take a huge loss. And that is a realized loss. Okay, goes in the books as a loss. Therefore, decreasing the amount of money that the bank has access to from a leverage standpoint, and also decreasing the amount of actual money the bank could get to give to someone else. So when you have a run on the banks, when people run to get, my client tried to take 100,000 out yesterday. They put in a withdrawal, a wire withdrawal. It was pending, and then today the bank got shut down. So they should be made whole on Monday. If you have money in here and you have FDIC coverage, you're supposed to get whole on Monday. That's what he was told. I believe that's going to happen. I believe I saw it in the news as well, but only if you have FDIC insurance. 97% of depositors in this bank did not have FDIC insurance. So essentially the bank, trying to be safe, trying to do the safe thing, overpaid for bonds. And then when the run on the banks came, once the weakness was smelled, which is also actually tied to Silvergate, it's tied to crypto, technically, and a liquidation that's taking place there. That made people worried about the bank. So people got worried about the bank. They made a run on the bank to withdraw their money. The bank all of a sudden fails because it can't make it. If you are leveraged, 15 to 1, and you lose 10% of value, you're done. That's it. That's how fragile the banking system is. So when you hear Bitcoiners like me, Bitcoin maxi as they call us, the system is actually set up. It only works as long as everyone's chill. The whole system only works as long as everyone is chill. When people freak out and they go and run on the bank to pull their money out, that is when everything could collapse. I mean, if people did this system wide, I mean, this could happen to anyone. This could happen to Bank of America. This could happen to, you name it. A run on the banks will bury them. It will. They all operate on leverage. All operate on leverage. So that's what happened to Silicon Valley Bank. Want to see an ugly chart? Oh, it's still inverted. Hold on. Ugh. That's the 1 week. That's the weekly chart. Silicon Valley Bank. Just back in November. Let's see. No, that's November 21. Hit its high at $765 a share. Today, trading was halted at 106 as the bank was seized by the government. Isn't that crazy? Just bananas. So a lot of people are saying, well, this is just the beginning. There's other banks that are in this position. Here's the reality of that. Yes, other banks are potentially exposed in the same fashion where they bought bonds. They got too much in deposits. They bought bonds at bad prices. The only way that it goes south for them, however, is if there's a run on those banks. If people start to freak out and pull their money out of the banks, then that would cause a problem for any bank. Hopefully, I've just explained why. That's what's going on. Let's see here. Oh, here it is. A bunch of other bank stocks have been sinking. Now, that's different than a run on the bank. So if you own the stock and you sell the stock, that doesn't actually hurt the bank. It hurts the bank's shareholders. When you go and you take and pull your money out of the bank, that is what hurts them. That is what caused the problem. And that is what ultimately did an end. Yikes. Now, a lot of people believe that there's at least one more of these coming. I have no idea if that's true or not. But I will tell you this. Typically, when something like this happens, it's not totally isolated. Meaning there's got to be some sort of ripple effect. Now, this is a really, really big bank failure. This was an enormous bank. I had no idea how big it was. There was gargantuan money in here. The ripple effects with this are definitely going to be far and wide, especially in the startup world, especially in the venture capital world, which is where a lot of this money was. If those companies, I mean, some of these startups are huge. They have millions and millions of dollars in their payroll. If they are just wiped out, then those companies are gone. Just gone. So I don't know what those companies might be. I think we're going to find out in the coming days. There's definitely going to be some sort of ripple effect. There may be other banks, maybe like First Republic, maybe people know something I don't, where that's also going to be a problem for them. Could be. If we see any more of this, it should be relatively soon. It shouldn't take like months and months and months for that to flesh out, because it's essentially a fear thing. This built up to the point where people ran on the bank. And when that happens, it's over. So if there's another one, the next one, if we just go back to the 2008 playbook from a banking standpoint, this is a completely different situation, but banks can fail for lots of reasons. And if we go back to that playbook, you remember we had Washington Mutual, we had Lehman Brothers, we had Bear Stearns, we had some big names that dropped. But if you go back and you look at that period of time, that actually ended up being like the pivot point. That was the point where like the bottom was almost was right there from a stock perspective. So I don't think we're there yet. We're going to look at a few different charts here in a second. Mortgage bonds today, we're actually up 33 basis points. That plus 22 is in after hours. 33 basis points today is about 0.1%. So mortgage rates improved today. pretty decently. Like I said, 6% is where I'm at on a VA high balance today. My rates are typically about 0.25% lower than these. So that is more a sign of health to me that, hey, listen, this bank went down because they bought bonds at the wrong time. They bought bonds too high. But yet, even though the market is essentially crashing, I mean, this is ugly, ugly tape today. Even though the market is essentially crashing because of that, investors still came to bonds. Perhaps because they realize this is a much better time to buy those bonds. This is a much better place to enter. If you need some exposure, if you need to maybe balance out, maybe you did buy bonds at the top. How do you average that down? You go buy some bonds today. That averages that down for you. And there could be some of that going on. So this could end up being really good for mortgage rates. Also, very good chance this slows the Fed down too. I mean, I think it's very, very likely that what we're seeing here with this bank and with the concerns of the other banks, I think the Fed is going to have to just go, you know what? Pause. And that also could be the pivot point for a bottom in the stock market, which we'll take a look at the charts here in a second. But one of those things is entirely possible. Jobs report, by the way, which is just completely overlooked, was really strong. This is one thing when people tell me like we're on the verge of a financial collapse or, market's going to crash or something like that. 31% of new cars are still sold above sticker. Pretty darn wild. 31%. 31%. Holy smokes. Just don't talk to me about a crash until at least the car dealerships are running specials to get people in the door. Like, let's not even talk about that. So silly. But it's also, hey, listen, look on the front page, Silicon Valley Bank shut down by regulators. Biggest bank failure since global financial crisis. The Bears are going to love this. I can't wait to see the videos this weekend that all the Bears are going to post. Oh, just beginning. This is the first bank. Then there's going to be another and another and another, and all the banks will be gone and we'll all be dead. They're going to love this. And it is what it is. I'm just trying to shoot truth here. So that's the chart for SIVB, Silicon Valley Bank. What are we going to do here? We're going to, by the way, we're live on Facebook, LinkedIn, YouTube, Twitter. Comment, say what's up, ask a question, help with the discussion if you want to. We're going to look at a few different things here. So first and foremost, S&P. I'm going to start here because a little birdie told me one time that when I was doing analysis of the Dow Jones, that was basically old man stuff. And I need to start checking the S&P. So here's what we're looking at. All right. What is happening here? We've got 2 bad days in a row, 2 really ugly days to finish this week. Those 2 days right here, these 2 red candles right here. This is the daily chart. Where are we at? Well, from our low, our swing low back here in October, that was when we hit the absolute low in this cycle, up into our swing high here in early February, on the 2nd of February. We now have basically almost an exact 50% retracement. So we got to bounce right off the 50 here, which isn't really a Fibonacci number, but people use it in their fibs, just like I am here. I think the key to look at here, as far as just what do we expect from the S&P, a couple things to note. Just stay very, very general here. Don't try to outthink anybody. We have higher high. Okay. So higher highs are being formed. We also currently have higher lows being formed. Now, this could change, right? This could change. This could continue to just, who knows, right? That's possible. And that could blow this out of the water. But as it stands, if we have a turnaround here, then, this is still bullish. Believe it or not. I mean, it's higher lows, higher highs. That's bullish. So if the bears are right, then there's a lot further that this stock or that the stock market's going to fall before you can really say like, hey, we can't even talk about being in a bull market anymore. It's got to fall a lot. It's got to go at least from where we are here at 38.62 down to 37. So let's call it 100 points. You need to lose another 100 in the S&P before you can even start to make any kind of argument that it's not still in a bull market. Not my rules. That's just how technical analysis works. So, and even that, you can still get a bounce off of the 618, which would be the previous low, swing low, right? And that would just look like a double bottom, and that could fire off higher. So you really have to bring it back to the 702 at least. And the 702 is pretty trusty. That's a trusty fib. That's my favorite one. And that's a ways down from here. That's 160 S&P points. So there's a lot of room there. It's possible. It's possible. I mean, this is not pretty. I mean, you talk about freaking people out. That's a good way to do it. When the front page looks like that, you start to enter into the phase of max fear. Max fear, though, is actually what makes a bottom. So keep that in mind. Maybe this isn't max fear yet. Maybe we're going to learn that there's other banks that are exposed, like First Republic or et cetera. Maybe we're going to find that maybe this fear thing, maybe it runs for a little bit longer. That could happen. If it does, based on the action we're seeing, though, it looks like mortgage rates will drop. And by the way, this really shouldn't affect real estate in a negative way. I don't see why. Maybe there's some people in like Bay Area who lost everything. How much that must suck, I can't imagine. But let's learn the lesson. Let's learn the lesson together, okay? Whenever you see something terrible happen to someone, try to learn the lesson without having to touch the same hot iron. The mistake that you can make here is having more than $500,000 deposited in any single account, okay? And that's considered a joint account. If it's an individual account, $250,000. That's the FDIC insurance limit, okay? $250,000 per person per account. So if you, like for me, me and my wife, if we have a savings account, let's say, we would cap that at $500,000. You would not want to have more than that in there. It's $250,000 per person per account. If we had $1 million in a savings account, guess what? If this happens to your bank, yeah, not pretty, right? So let's learn the lesson. Let's make sure that this doesn't happen to us. Like take stock, talk to your buddies. Let's make sure that this does not happen to them. Please. Doesn't have to. Doesn't have to. Man, just sucks. Sucks to see that happen. You know, people are in extreme pain today as a result of this. Just brutal, brutal, brutal stuff. Okay, so that's the S&P. Still looks bullish. I am technically short the NASDAQ here and have been for a little while. Now, the reason why I bought that insurance is because the stock market, just the structure overall to me did not look great. Why is it doing this? What are you doing? Overall, did not look great, but particularly the NASDAQ. So like the Dow chart looks better than the S&P. The S&P looks better than the NASDAQ. It's weird. They're all indexes, right? But they cover different things, different sectors. This one just, to me, when we made this again, lower high here on the daily, just kind of like, gosh, man. I mean, I'm pulling for it. Like, I hope that my puts go to zero because I really would prefer to see the market go higher. But I just very, very concerned. And then when we re-entered this previous range that we had exited, you know, it just looks like a fake out here. That's not a good sign. That's not a good sign. Not a good sign for the NASDAQ. But also the reason one of the other reasons that I'm short the market is because of just insurance against geopolitical situations. We saw the Chinese spy balloon. We know there's talk about nukes. We have stuff going on with Russia, China. Our president can't speak a sentence. You know, it's not a great situation. There's potential issues there. We have a Federal Reserve. As nice of a guy as Jerome Powell is, they are utterly incompetent. Please argue that with me. Just because someone has a degree and wears a bow tie doesn't mean that they are like going to get it right. You know what I mean? They're too far away. Making decisions from an ivory tower has never worked, ever. It's not going to work this time either. Bitcoin has been getting shellacked, and that's right from the levels that we marked. How long ago did we do that? Months ago? The first test of this level, a huge rejection. Went from 25 down to 18. Then we had that liquidation situation all the way down to the lows in the 15,000 range, ran it back up. I was surprised. We got rejection at this level once and then just burned right through it the second time. But when we came up here to this 25,000 level, again, rejected hard. Now, it was holding up nicely. In fact, the last video I made, I think I said something like, hey, it's holding up okay. It's not rejecting that bad. And then immediately afterwards, just and this wicked down into the 19s, even though it's still over 20,000 right here. Very good chance that we revisit this area here. Very good chance that Bitcoin at some point revisits this area. Now, this would be a great place if I was trading Bitcoin. I would 100% be looking to buy. The perfect entry would be like right there. That would just be perfect. You know, give me the ascending channel, give me the previous support, give it to me. Those two things combined here on a daily, I'll take that. Buy that if it comes. And I very well may do it. Just seeing that right now, that's kind of a perfect setup. But that would mean that we need to see Bitcoin get back down to 18,000 again, which would mean there would have to be another something in the market, pretty significant. And so that could happen. That very well could happen. Now, the one stock that was green today, Tesla. What? How is Tesla green today? Well, I don't know. I don't know. I bought some today. I've been buying it pretty regularly. I'm trying to accumulate quite a bit of Tesla. Started buying it down here. Actually, I started buying it 157, which was right here. And then I bought it all the way down. I did not get my bids filled at 100, but the last ones I got filled were at 105. And then I've been buying on a regular basis ever since. I held off for a little bit when we were at this resistance level. So I didn't buy in any of these days here. And then once we peeled back from it, I started purchasing again. And I purchased again today. I do think this support level should hold. If it skips over, though, if it gaps down below this, remember what happens. If Tesla gaps down below this, it's see you later. In other words, if it opens up Monday, like right here, then bye-bye. That's why it's important to chart these out, because if it does open down here, I'll be more patient. Like I won't even buy, even though that'll be lower than where I have bids in. I would actually not even buy if it gapped down that low. I would wait, because that would mean we're going to see a run lower. And where to is hard to say, but actually let's take a guess. Take the cycle low, cycle high. I say 702. So 135 would be the last stand if it's going to remain bullish. 145 would just be a 618 retracement. Ho hum. And if the 702 breaks and we go below 135, then it's hard to not imagine seeing a new low. Because if that were to happen, that would mean that really bad stuff is going on. Liquidations are taking place. And some of these companies, some of these startups, some of these firms, some of the funds that are invested heavily in tech and Silicon Valley stuff, it's a very good chance that they have exposure to this. It's also a really good chance that they own Tesla stock, right? And so if they do, and they have to liquidate stuff for other reasons, this might be the one thing that's, maybe it's up a little bit, or maybe they just dump it figuring, hey, we'll buy it back later. So I'm a little bit concerned about Tesla for that reason, but today it was up. That's not too shabby. I'll take that. My portfolio got murdered, but other than that, we're good. Meta is still holding above this ascending channel formation. Remember the massive gap up from the big earnings surprise? It's still holding that. Look, we bounced off of that and moving higher, still on that. So that, to me, this is still a very good formation. I'm still expecting Meta to do very well here. We should probably go ahead and chart this topping scenario. Especially if it breaks through that and continues to ride the high side of this channel, that'd be a very good look for Meta. And this is a stock that I think can go to freaking infinity in the long run with the metaverse and their 100% monopoly that they have in that metaverse. So I still like that one quite a bit. Oh, what I was going to show you, I forgot to mention this earlier. Look at this. So this is Silicon Valley Bank, one of the ugliest charts you could possibly imagine. This is today. That's today. Look at this. Let's see. They had an earnings miss. They missed earnings by 67 cents January 19th. So they missed earnings by 67 cents. Pretty bad miss. However, the stock gapped up after that. You see that? Big earnings miss, stock gaps up. How? How could that be? That is a question I think someone's going to have to answer in front of a judge at some point. There's also some insider selling that happened that kind of doesn't make sense. There's some question marks here. But if you look at the previous earnings, and if you go back and look at just all the earnings, they were doing really, really well. I mean, they were murdering on earnings. Murdering. Upside surprise, $2 a share. What? Surprise up 3 cents a share, 67 cents a share, $2 a share. Again, they were just crushing it. People have enormous amounts of money in this bank. Not anymore. Not anymore. Let's see if anybody has anything to say. All right, let's go here. The herb of Wall Street. Hey, with the bank failure, et cetera, will there be any effects on single-family real estate in San Diego? Hey, that's a good question. I don't think so. I posted this. Let me see. I'll pull this up. I'll actually pull this up. I've got this right here because I posted it yesterday. Or did I delete it? No, here it is. This is all I'm looking at from a San Diego real estate standpoint. This is really what matters right here, right? Let's look at current actual stats. So here we go. And where is it? And what are the trends? So we look at this price per square foot. Sorry. Price per square foot is trending higher. Average days on market trending lower. Median days on market trending lower. Price decreases trending lower. Price increases, I've never cared about that stat, but it's just pretty much flat. Relisteds, don't really care about that. Inventory trending lower. Rent, relatively flat, but recently trending higher. And then the market action index trending higher. So like all of those things are things that are bullish for real estate. So that's what I'm looking at. I'm just looking at the data. You know, my feeling from a boots on the ground standpoint as a lone guy who's working in this market, we are constantly getting beat by other offers, just constantly. You know, getting 1 or 2 escrows a weekend with a dozen offers going out over the weekend. I mean, we had a good week this week, but yeah, a lot of people are still in fistfights for houses. So, you know, actually, I guess you can't see that. Hold on, let me hide this. Thank you, the Herb of Wall Street, for that question. And we are live. You can ask questions. You can say what's up if you want to. But so when I see price per square foot, that's my number one item. That's the number one thing I look at. Which direction is that trending? Trending higher. Days on market, trending lower, bullish. Price decreases, decreasing. So less people are dropping their price. Inventory going lower. And that's really the big story. It's really just an inventory story. There's just not enough, plain and simple. I got people who've still been looking for months and months and months and months and months. Going back to last summer. It's tough. It's tough out there. And the market action index is the Altos Research custom indicator that they use, factoring in a bunch of stuff to determine what is the temperature of the market. Is it a seller's market? Is it a buyer's market? And right now it is considered to still be a strong seller's market. So until some of these things change, like you basically would need to see the opposite of this. Okay. You basically would need to see price per square foot trending lower. You would need to see days on market trending higher. You'd want to see price decreases trending higher. You would want to see inventory trending higher. And you would want to see the market index trending lower. If you want to be bearish about real estate and have something to back it up with, that's what you would need to see. We have the opposite of that right now. We're the exact opposite of that. So it's a very easy argument. Like if someone wanted to argue with me that the market was weak or something like that, that'd be really, really silly of them. I would crush them. But but at the end of the day, that's just not what we have. It's just not. So I got to tell you what, it's 5 o'clock somewhere, and my clock says it's 5:01, and I've got a margarita with my name on it, a Paloma, my fave. We're going to go that direction. So look here, guys, here's the deal. There is going to potentially be some rough waters here in the coming days. I want you to be prepared for that, but also want you to know the reality of what's going on. Like, why is this happening? Is it something to be uber concerned about? Is it something we need to watch more closely and see what happens? I'll continue to update, follow wherever you're watching this. If it's YouTube, if it's Facebook, if it's Instagram, you'll see my daily reels. I'll be covering this day by day. I think every day next week, we're going to have new information coming out on this, and I'll be bringing it to you here. In the meantime, be around this weekend if you need me. If you like wholesale loan rates, that is. Those are low ones, by the way. No lender fees at all. Shoot me a call or text, an email. I'll be here, be around this weekend to help you if you need me. Have a tremendous couple of days. Chilling. What's up, Kathy? Be careful shorting, Herb. Be careful. B-O-G-G. Appreciate you guys. Have a great weekend.